Hi, everybody. This is Alan Ellman, the Blue Collar Investor, welcoming you to this BCI podcast number 96, titled Protecting Our Covered Call Trades. We're going to discuss protective puts versus using in the money call strikes. And we're going to be using this with a real life example with Centene Corporation, which trades on the New York Stock Exchange under the ticker symbol CNC. So, in essence, we're going to be discussing how to protect our covered call trades or to take a defensive posture with our covered call trades. So, how are we going to mitigate risk with these trades? Well, there are two approaches I'm going to be discussing in this podcast. The first is to convert our covered call trade to a collar trade. The way that works is we first buy the stock, which is typical for a covered call trade. We start with buying the stock or taking a long position, and then we sell a covered call. Now, in the case of a collar trade, we would normally opt for an out of the money covered call, which is a strike higher than the current market value. So we have a contract obligation to sell our shares at this higher strike price. Now, the additional step for the collar trade is then to buy an out of the money protective put. Now, for puts out of the money means lower than current market value, and that gives us the right to sell our shares at that strike price. So the covered call strike out of the money creates a ceiling on the trade. We cannot participate in any share appreciation above that strike price. And the put strike, which is below the current market value, protects us or creates a floor, which means if the price of the stock drops below the put strike, we will not lose any additional money. So that's how the collar works. Now, another approach to mitigating risk with our covered call trades is to use in the money call strikes. Now, an in the money call option will have two components to its premium. It'll have an intrinsic value component, which is the amount that the strike price is below the current market value of the stock. That's known as the intrinsic value. Everything above that is known as the time value. And our actual initial profit is the time value component of that in the money strike. So we can't count the entire premium as profit when we sell an in the money strike. We have to break that down into an intrinsic value component, which is downside protection, versus the time value, which is our initial profit. But because there are two components to an in the money call strike, that means the break even price point will be lower than had we sold an out of the money or an at the money for that matter call strike price. And that gives us the additional downside protection or creates a more defensive posture to our covered call trades. Now, I'm going to be throwing a lot of numbers at you now. Those of you who are actually also watching this podcast, you could see the screenshots. For everybody else just listening, I will describe the option chain on 4/16/2020 for the May expiration. So they're 1 month out. At the time, CNC was trading at 71.27. So we're going to look at the out of the money call strike, which was the 72.50, which generated a bid price of $3.90 per share, or 390 for the contract. Now, we're also going to be looking at in the money call options. When we're going to check that out, we're going to look at both the 65 in the money for calls is lower than current market value, and the 67.50. The 65 had a bid price of $8.50, and the 67.50 had a bid price of $6.80. So we're going to be feeding that information into the calculators momentarily. But if we were going to do a collar trade and we sold the 72.50 out of the money call strike, then we're going to take a look at two put strikes that are out of the money or lower than the current market value of 71.27. So we're going to have a look at the 67.50, which had a ask price of 320, and the 65 out of the money put strike, which had an ask price of 255. So all those numbers we're going to be feeding into the calculators, and we're going to be getting results that will help us make sense of how we're going to mitigate risk. So for the collar trade, we're going to be using the out of the money 7250 call strike, which is going to generate 390. And we're going to have a look at two out of the money put strikes, the 65, which generated 255, which actually cost 255, and the 6750, which cost 320. Once again, the in the money call strikes, which we'll be evaluating, is the 65, which generated $8.50, and the 6750, which generated 680. Let's get to work. Now, we're going to first have a look at the collar calculations. Okay, so if we bought CNC at 71.27 and sold the 72.50 strike, we're going to have a look now using the out of the money put strikes of 67.50 and 65. So let's break it down. Now, for those of you watching this podcast, check out the red arrows, which gives you your initial return. For the 67.50 put strike, we're going to have an initial return of 0.98% for a 29-day trade, which annualizes out to 12.36%. Now, the 65 deeper out of the money put strike, which actually costs less money, is going to generate a higher initial premium of 1.89% initial time value return, based on a 29-day return that annualizes out to 23.84%. So those are the results if the price does not change. No price change at all. So let's have a look now at the two other scenarios. The price goes higher than the call strike, and then the price drops lower than the put strike. And for those watching, that would be represented by the blue arrows. So if the price, and by the way, this is maximum return. So if the price moves higher than the call strike at 72.50, our return at the end of the contract will be 2.71%, annualizing out to 34.08%. Now, it's going to be a little higher for the 65 put because it cost us less. So that means that the final return will be 3.62%, which annualizes out to 45.56%. Okay, so those are the two scenarios we've gone through so far where the price didn't change or the price went up beyond the out of the money call strike. Now let's look at worst case scenario where the price of the stock drops precipitously below the two put strikes. Let's start with the put strike at 67.50, the higher of the two put strikes we're going to look at. If that happens, we have a loss of 4.31%. That annualizes out to 54.22%. Now, the lower put strike is a little bit worse because we have less protection. We're only protected below 65, not below 67.50. So our loss in that case, without exit strategies, by the way, is 6.9%, which annualizes out to 86.89%. So that gives us protection against catastrophic share decline and assumes no exit strategy execution. Of course, if the price of the stock starts declining that much, we would execute our typical covered call writing exit strategies on the short call. But that aside, this gives you an overview of the mitigation using the collar strategy. Now let's finish up by looking at the in the money call strikes, which have the intrinsic value component giving us additional downside protection. Now feeding this into the covered call writing BCI calculators, the basic one is called the Ellman calculator, into the multiple tab, we see that the 65 strike represents an initial return on our option, or ROE, of 3.4%. And remember, this is a 1 month return. But the downside protection is huge, 8.8%, because the break even is at 62.77. So we have a greater a better break-even point, a lower break-even point by using that 65 in the money strike compared to the higher 67.50, which, as those of you watching can see from the screenshot, actually generated a higher return on our option of 4.5%, but gave us less downside protection of 5.3% and a slightly higher break even at 64.47. So the lower in the money strike gives us a lower return, but still significant return and greater downside protection. The higher in the money strike gives us greater initial time value return, but a little lower downside protection of that time value profit. So, but depending on which strike you select, both will give you additional downside protection, meaning you're taking a defensive approach and helping to mitigate risk. Both of these will accomplish that, just to different degrees. Let's summarize. Risk reduction for our covered call trades can be accomplished in various ways. Two such ways are buying protective puts, converting the covered call trade to a collar trade, or using an in-the-money call strike, which gives us the intrinsic value component, which gives us additional downside protection. So collars will protect us against major gap downs. Some terrible news comes out, bringing the price of the stock down significantly, but it costs money. We have to use our cash to buy those protective puts. In the money strikes will give us additional downside protection, will not protect us against catastrophic share decline, but will be paid for by the option buyer, not us, in the form of intrinsic value. Both approaches will mitigate risk. Okay, I want to bring to your attention our BCI package, which is an acronym for our best and most comprehensive educational product ever offered by the blue collar investor. It consists of 6 online video courses with downloadable workbooks, 6 calculators you can find only on the BCI site, along with 5 of our best-selling books in ebook format, along with our annual premium membership, which is 13 months of membership. You can find the link for more information on the BCI package on our website, thebluecollarinvestor.com. Those of you looking, you could see the circled link. It says BCI package right on the top of all of our web pages. I even created a video to help explain in detail everything included in this BCI best and most comprehensive educational package. I want to thank you, ladies and gentlemen, for taking the time to listen to this BCI podcast number 96, Protecting Our Covered Call Trades, discussing both protective puts as well as in-the-money call strikes. I hope you enjoyed this presentation, folks, and most importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.